It's time to kick in with the first panel of the day, and as it was already discussed, there's so much to discuss. It's a very dense discussion, and we're going to tackle the future of corporate taxation. All the panels will be 45 minutes discussion and 15 minutes Q&A, so if you have any burning questions, please hold it to the last 15 minutes so that we make sure that they're tackled by the discussants. So the first panel is going to be moderated by Paola Tamma from Politico. Paola, please, can you join us on stage? And to discuss this very important issue of the future of corporate taxation, we have Mona Barake from the EU Tax Observatory. Mona, please. Marcus Ferber from the EPP, please, Mr. Ferber. Giorgia Maffini from PwC. Giorgia, thank you very much. And Chiara Putaturo from Oxfam EU. And since it's such an important discussion, we have a guest, an additional guest in this discussion, Benjamin Angel from the Commission, please. Thank you very much. Paola, the floor is yours.
Thank you very much. Welcome. And I'm very pleased to have Mr. Angel, but everyone joining us today on this panel. I will run through your titles if you don't mind, just in case. Mona is a postdoctoral fellow at the EU Tax Observatory. Marcus Ferber is an MEP with the EPP and vice chair of the subcommittee on tax matters. Giorgia Maffini is a special advisor on tax policy and transfer pricing at PwC. Chiara Putaturo is EU Inequalities and Tax Policy Advisor at Oxfam EU. Benjamin Angel, Director of Direct Taxation at DG Taxia, the European Commission Department on Taxation. So we are here to talk about the future of corporate taxation. I'd say we dive right in. Today's economy being so globalized and digitalized, it's very difficult to actually make sure that the taxman can do its job. It creates a number of challenges as companies can avoid paying taxes in countries where they make profits. In light of this, I would ask you, Mona, and then we'll turn to the other speakers, why is there a need to reform corporate taxation?
Thank you. So, is the mic working? Yes. So, it is a very important topic because of many reasons. First, as you know, globalization has made the multinationals' structures very complex, and adding to that, the digitalization also brought another layer of complexity, because multinationals now can book their profits in low-tax countries or tax havens, or even in countries where they do not necessarily generate profits from, and this creates a disconnection between the countries where the profits are actually made and where the real activities are there, with respect to where the multinationals are actually putting these profits in low-tax countries, and thus the global economy is losing taxes. And for that specific reason, the OECD and the different governments are launching, either digital taxes or the Pillar 1 initiative or the BFIT to tackle these mismatches that are being created.
Thank you for that. We'll go in around, but maybe starting from Monsieur Angel. So you're in the driving seat of reforming corporate taxation for the EU. What is your priorities?
Well, internationally, there is an issue of fairness, as Gabriel was explaining, and this issue is supposed to be addressed primarily via the OECD process of Pillar 1 and Pillar 2. But within the European Union, we face also clearly an issue of complexity. Our tax base is extremely variable, it's not very readable. Doing operation within the single market is made more complex because of the variety of tax system, because of the deal to interact with various tax administration in various languages. And this is one of the challenges that we want to address via BFIT. Not only for multinationals, Gerasimos has mentioned the intention to come up with a simplified tax base with element of harmonization for multinational and formal reapportionment, bringing also a one-stop shop, the possibility of cross-border compensation of losses and other advantages that facilitate the operation of MNEs within the single market, but also for SMEs. I think it's very important that we engineer major simplification for SMEs. The SMEs are too often forgotten in the EU approach. The EU approach so far has focused primarily on multinationals, a very big one on top, not even the medium ones, those which have a turnover above 750 million euro. BFIT as announced by the President von der Leyen during her State of the Union speech, will generate an SME simplification shock. We are working on a very important measure. One of them is to allow the SME to operate when they have activity in another member states, but without having subsidiaries. They're just permanent establishment. We want to allow the SMEs to operate exclusively under their domestic tax base. And the other country will just communicate to the home country the tax rate to be applied to the operation on its territory. But today, the SMEs which are active in another country, they need to know the tax base of that other country. They need to interact in foreign language, which can be challenging. Tomorrow, if BFIT is adopted, we will allow those SMEs to interact only with the tax administration and only in the country they know best, in the language they know best. That is a major simplification that should allow a bigger access of SMEs to the internal market and lower the cost of doing business in the EU. I think it's important that we seek not only of the big, but also the small and medium, and this is our top priority.
Thank you. Chiara, from a civil society perspective, what would you like to see coming from the Commission in the BFIT and more generally on the tax agenda?
Yeah, for us, tax is a priority both for raising revenues, that is the topic of today, but mainly for reducing inequality. So it has been, the speakers before have talked about fairness and an equal tax system, and we see it in three aspects. So both the unfairness and the unequal playing field between the small and medium enterprises and, as Mr. Angel was saying, and the big companies. Then we have to think about that when there are huge and windfall profit, the people that are gaining from that are the company's owners, are the bigger shareholders, people that are already rich, and so this cause also a concentration of wealth. And third, there is an inequality in the tax system in terms of between low-income countries and rich countries. Why? Because the headquarters of multinational are mainly in rich countries, and also if we look at tax avoidance, the low-income countries are losing more because of tax avoidance if we compare it with their GDP and with the total of tax revenues. So it's important to address the unfairness of the tax system, and we should look not only at at BFIT and Pillar 1, but also at windfall profit taxes.
Thank you. And Georgia, coming from somebody who advises companies, what are the issues that you oversee and what are the main requests that you get from your clients?
Mainly, Paula, I think that in my career transitioning from the public sector to the private sector, the biggest shock I had is how complex the corporate income tax system, especially the international corporate tax system, is today. I think we are very close to a point where the system is becoming untractable from the perspective of the taxpayer, a taxpayer that needs to operate across 27 markets or even more globally. So probably, and many of the reforms that we have seen in the last 10 to 15 years, although we understand why they were there, have made the system even more complex. So there is a question of how much can we continue to push forward on that type of agenda before the system becomes unfunctional, essentially. So I think from the point of view of business, especially in Europe, it's no longer about reform. We understand that the elected governments need to bring in the reforms that the electorate wants. But I think there is a request of doing these reforms in a way that is technically, that works well technically, but also that at a certain point we will absolutely need to think about the complexity. And it's very good to hear Mr. Angel talking about that, And this is just not. So when I was on the other side, I thought that this was a mantra that business had. I now think that it's a very important issue that has a lot to do with the competitiveness of the continent and of our economies, essentially. And it's a low-hanging fruit. You don't need to lose revenues with a simplification of the system.
Thank you. And Mr. Faber, we come to you. You're the elected representative on this panel, so what are the demands that you will bring once the Commission comes forward with new proposals and generally on the tax agenda?
Yeah, thank you very much. I'm not only now member of this subcommittee. In the last legislative period, I was member of all the inquiry committee and all the 3 special committees we had established to do some investigations. And honestly, before we start to think what's going wrong globally, we should clean our internal problems. And honestly, we have a lot of them. And I'm very happy to have a letter from former Commissioner Moscovici in my hands, who wrote me that there are no tax havens in the European Union. And sorry for that. It was the most ridiculous letter I ever got from a commissioner, as my favorite tax haven is Madeira Island, who has, since the accession of Portugal in 1981, a special tax regime, which is valid, for example, for football players like Ronaldo. His company, who is dealing with all his rights for pictures, is located in Madeira, has a revenue roundabout of 70 million euros without paying taxes, or 5% in total. So sorry, before we go outside, we have to solve our problems internally. And that is our main attempt as European Parliament cross-party, if we get rid of these problems. We thought we found an angel via state aid rules, and that is what Commissioner Vestager introduced in a lot of cases, or a handful of cases. The most problematic ones, the most famous one maybe the Irish case linked to a company named Apple, but it was against Ireland, and it failed at the Court of Justice. That shows we have to solve some problems internally, because a single market, and I fully agree what has been said, a single market cannot work if we have an unfair tax competition. And everyone agrees that inside a single market you need more rules or equality than we have at the moment, because that is really disturbing the internal market. And the United States are an internal market. They afford 20% of states with being identified as tax havens. When we visited the federal government in Washington, they told us, yeah, but the state tax is very low in comparison to the federal tax. That's not very helpful. I think they have internally problems as well, which have to be addressed. But before we start accusing others, we should solve our problems internally, and that's why we are so disappointed, because the CCCTB was the 3rd attempt, if I counted correctly, to overcome the problem only on the corporate taxation, which is only a small part of the tax world. I'm a member of the European Parliament since 1994, and since I'm here, I've been told we have problems with the value-added tax, and huge problems around that. We had a long time ago inquiry committee which said that even the European Union loses 1 billion euros a year out of the VAT fraud. If that would not happen, even the European Union would have 1 billion euros more a year. Until now, we've not been able to address that. And that is what I really think we want to push as Parliament, which has to be pushed. And therefore, we are really disappointed, and that is between all groups. The taxation is still unanimous in the Council, and that does not create any progress. And even initiatives like the BEPS initiative worked more or less successful, as mostly member states have agreed. But if I look to the BEFIT, I have some concerns that there will be no unanimous decision, but the Parliament will push that, of course.
We'll get to those. We've framed a bit the problems, and I'd like to tackle some of the answers, or at least what are some of the possible answers for reforming corporate taxation. Let's turn to each in turn, if you would agree. Starting with the digital service taxes, which are mostly national efforts to come up with a way of taxing profits where they're made. Then Pillar 1, which was the first leg of the OECD agreement on taxation, which redistributed taxing rights on the base where the final user is, and the upcoming BFIT proposal, on which we touched upon already, on formally apportionment, which the Commission plans to present this year. which aims to create one single corporate tax book for the EU. So maybe going through the row, how do you rate them in order of preference? And very briefly, if you can tell us why. Mona, first with you.
Okay. So I'll start with Pillar 1. So Pillar 1 is a proposal that will reallocate part of the residual profits of the largest, really the largest and most profitable multinationals around the world to the different countries with respect to where the sales are taking place. And when I say most profitable and largest, there's a huge threshold, which is 20 billion euros of revenues and 10% of profitability. So this leaves us with only around 69, 70 multinationals. So not a lot. And then an issue with this is that the revenues are going to be limited. And also, unfortunately, when we do the estimations, we see that most countries who will gain from Pillar 1 are going to be developed economies, especially the US. Adding to that, for Pillar 1, so the benefit of it, of course, is that it's the first, one of the first proposals to distribute the taxing rights to countries, because many countries before didn't even think about being able to tax Facebook, because Facebook is not, for example, physically present in their country. So it has a huge, of course, opportunity in bringing such ideas to the table. But at the same time, the design of Pillar 1 is still, limits the total revenues that we can get out of it, because it's going to bring around 15 billion euros for all countries. And if we compare to the Pillar 2, the minimum tax will bring around 155 billion. So you can see 15 and 155. So for the revenues, Pillar 1 is still limited. When we come to the DST, the digital service taxes, we can see that it can bring almost the same as Pillar 1, but of course the issue is that it's unilateral measures, so it will create double taxation issues. It can create also some issues between countries, trade wars, etc. But it will bring almost the same revenue, and it's not as complex. And also fits the idea of redistributing, taxing rights to countries. Even if the multinational is not physically present, the country can still, claim some taxation on the profits that have been made in that country. For the BFIT, it is kind of close to the idea of Pillar 1, but with a different formula, because in the BFIT, the idea is inside of the EU to create a consolidated profits to make probably taxation easier and less complex, and then to reapportionate these profits with respect to not only sales, like in the Pillar 1, but also to where the employees are, their compensation, where the assets are. And even it might include also the intangible assets. And the whole purpose is to also redistribute these taxing rights in the EU with respect to where the real economic activity is taking place. And also it might create some additional revenues. Going back to your question, after presenting a bit some positive and a bit of negative sides of each proposal. So there is no one proposal that will actually answer everything, but maybe in each one we can take some of the designs and create a proposal that fits, each of the expectations of countries, because each country is expecting, additional revenues and taxation, and some regulations like Pillar 1 doesn't answer this. For example, developing countries. For BFIT, maybe some also member states will expect more, but they will gain less. So there is no best regulation until now, but the designs and the ideas are very, very important in this digital age.
Thank you, and thanks for also the very knowledgeable explanation. Can we run through the rest of the panel quickly on, most favorite, least favorite?
On the digital service tax, the Parliament has made a proposal inside the CCCTP proposal. I think it's a very easy one, easy to calculate, easy to understand, and hopefully easy to pay as well. And therefore, the Parliament is in favor of that. In total, we agreed on that as well, cross parties, cross groups, cross member states. Unfortunately, the Council has not taken it up. We know we have some member states who have it already nationally introduced. It's one of the burdens. But even to have common rulings would help, because the other thing is, of course, which is our idea, to get it as own resources for the European Union. But if you have it already nationally introduced, it's hard to convince those member states to transfer it, what they have already as income on European level. But beyond that, we are in favor of introducing that with a harmonized approach, that this way of avoidance by shifting profits somewhere internally in the European Union is not possible anymore. So I think what we have proposed is a helpful tool to achieve that. On the Pillar 1, of course, we have to wait what the OECD in its wisdom is delivering finally. There's a general agreement, but as always, the devil is in all the details, and the momentum, I think we lost a little bit the momentum after the agreement of Pillar 2 and the general agreement on Pillar 1. A lot of time passed away without creating huge progress. So that's my main concern, or can really speak on behalf of the Parliament, that's our main concern, that we lost momentum on those member states, internationally engaged in that. And I think as closer as we are coming to the elections in the United States, as worse the conditions are, to have support from that side, which is needed for the Pillar 1 very importantly. And the third thing, we on the
BFIT, if you have thoughts on it.
yeah, on the BFIT, the Parliament asked for a long time for that, so we are happy to get it as soon as possible.
We'll come to the complexities of getting any of these ideas on the ground, but first I'll give you all a chance to rate these proposals.
Paula, maybe in the interest of time, I'll focus on my least favorite among the three proposals, which is the DST. And I apologize, we don't agree on this one, because
that's not what we have to do.
So DSTs are essentially gross taxes, so they do not allow for the deduction of costs to run a business. This means that they are the most distortive taxes that you can introduce in the tax system. And it turns out, because I think our founding fathers were quite smart, that we eliminated from European tax system this type of taxes a long time ago, when we started to introduce a very nice, very European tax, which is VAT. Okay? VAT was theorized in Germany first, about 100 years ago, and then it was introduced first in France. So a very European tax that does exactly what DSTs do. They tax in the market where the goods and services are provided. But VAT is less distortive because it allows for input deduction. So in a way, trying to tax in the market or raising revenues, raising own resources with DSTs is a bit like wanting to go somewhere and you have this new European electric car which you can use, but you decide to use a horse and a cart. So you might get there, but you might not get there in a super good form in terms of raising your revenues. So we should really rethink, just because we have a much more sophisticated tool already available to do exactly the same thing. And when we work with taxpayers, you really see how the DST is distortive. For example, you have to pay a DST even if you're running a loss. And we had lots of taxpayers that, for example, during the pandemic had to pay DST, but they were running a loss. If you think of the platforms in the travel industry or platforms that organize live events, you can understand why they ran a loss during the pandemic. Or, and this is a structural problem, you have platforms that grow very quickly in terms of revenues, so they become in scope of DSTs, but because they are still paying off their investment in technology, they are running a loss. Still, they have to pay tax. And there, of course, either you increase prices or you don't invest, or both. So I think overall, rather distortive taxes, why not use something that also has a very European flavor like VAT to do exactly the same thing? And by the way, with VAT is already there. The system is already there. You can raise revenues today or tomorrow. With the DSTs, we had to put in place taxes, and in some countries they came in 2020, and I assure you that we are all still learning how they work from both the tax authority and the taxpayer side. So, yeah,
At least
I'll stop here.
quite clear. I see Marcus is shaking his head, but we'll get there.
Sorry.
Please get it.
Yes, I think the BFIT is for sure the most revolutionary proposal, maybe also the most difficult then to get the unanimity, but we talk about it later. Of course, it depends also how we design it. It should cover all sectors without exemptions. It should be based on a formula that really reflect the economic activity, so on tangible assets and not intangible assets. One of the limits is that is just apply in the EU. So we don't address that kind of inequality I was talking before between the low-income countries and rich countries. There was an attempt, so at international level, to address that kind of inequality with Pillar 1. But as has been already mentioned, the ambitions of Pillar 1 were lowered down. The scope is quite small because the revenue threshold is high. There is a low reallocation percentage, and just 25% just on the 10% of profitability. And also, if we did a calculation of 52 developing countries, if they have to implement Pillar 1, amount A, or a digital service tax of 3%, and it will be more convenient for them to implement a digital service tax. And with that, I pass to the digital service tax. So I agree that it's not the solution. It addressed only one sector, but it helped in push other kind of reforms. And just to conclude, to have a really revolutionary reform at international level that is really democratic, we need to discuss it at the UN level. There were some progresses in the last month, and there is a work to establish a convention, a UN tax convention. And so it's there that we have to look at to really involve all the countries to have a really redistribution between low-income and rich-income countries.
Thank you. Monsieur Angel, since you're going to father at least one of these, you might be biased, but I'm going to ask you anyways.
Well, I will start by being less critical about Pillar 1 than previous speakers. I think this is one of the occurrences where the journey matters as much as a destination. And the fact that we were able to build collectively a major international cooperation in the tax field is obviously to be welcome as such. It is true it covers a limited number of countries, but you have to remember that it is a company, but you have to remember that it is foreseen that the threshold would go down to 10 billion after a few years, so as to capture more companies in scope. It's a major breakthrough. Let's call a cat a cat, and let's hope that the ratification process will be smooth and conclusive. It's difficult to compare the Pillar 1 with DSTs. It is clear that the process itself was launched originally primarily because many countries, starting with the European country, were frustrated with the difficulty to tax the digital sector, and it has evolved into a more complex animal with almost all sectors being covered. And I would assume that the issue of DST would resurface naturally in the event where Pillar 1 would face to materialize. But if you compare the two, you have evident shortcomings attached to DSTs. I should say immediately that I don't have a black and white view as regards DST. When I started on taxation, which is still relatively recent, 3 years and a half ago, even though I joined the EU actually the same year as Mr. Ferber joined the Parliament, my view was relatively negative as regards DST. And then when we started to study it, the fact is that we have some companies in the digital sector which have quite a specific business model where they grow until the moment where they are dominant without ever boosting profit. And that cannot be addressed via the corporate income tax system as such. So I understand why a number of countries have gone for DST, starting with 4 member states, but not only our 4 member states, because we have 12 DSTs in place in the world today, and many which are considering it. At the same time, it is clear that if you face an avalanche of DSTs, if you move from 12 DSTs to 30, 40, 50, 60, you end up double taxing, triple taxing the same flows, because people will come with different methods, different way of assessing the sales by destination, and then you create some kind of international chaos, which would not be the case if you had a global agreement on DSTs, but that is not the counterfactual. So in that sense, I think it remains primordial that we manage to get a successful Pillar 1, that it is progressively broadened to a higher number of companies, because this is the road to go if we want smooth international tax relation. Now, BFIT is obviously extremely important for the European Union as a whole, but it's only for the European Union. BFIT as such is not aimed to bring more fairness or more simplicity for the relation with a third country. We only legislate for ourselves. But one could assume that if member states manage to agree internationally on a formulary apportionment with the rest of the planet, maybe can we have the naive hope that agreeing a formulary apportionment among themselves in the single market is not entirely beyond reach.
An optimist by nature. Okay, well, actually, you preempted my next question, which is let's talk about some of the complexities of creating these ideas which we're discussing into reality. We've mentioned some of them, the US opposition and US forthcoming election. We touched upon EU unanimity on tax issues. So I will start with you, Mr. Angel. The question in my mind is, why would EU countries agree to BFIT? And you kind of answered it already, or at least you answered your hope when they let the proposal for a common consolidated corporate tax base languish for over a decade.
Well, that's a very legitimate question, because as many have reminded, we have tried in the past twice already to come up with a framework. And I think it's Einstein's definition of insanity to try again and again the same thing while hoping for a different result. But something has changed. And what has changed is that with Pillar 1, member states have accepted a formulary apportionment. With Pillar 2, they have accepted some commonalities on assessing a tax base, the use of financial accounting. So clearly, these are elements which were deemed unreachable a couple of years ago. Will the discussion on BFIT be easy? No, obviously. It's a very complex discussion. It will be a very difficult one. It's challenging by definition. It will be also a very long directive, probably around 150 pages. So it's not something that you discuss overnight. But among us, is there a single person that would have bet 5 years ago on the success of Pillar 2 internationally? Honestly, I don't think any of us would have bet on the success. And yet we have it. It's becoming reality. Not only the EU, the whole world is following through in legislating progressively. So it shows that even though it is challenging, optimists are not necessarily dreamers.
I was just in Israel where I think Mr. Herzl said, if you will, it is no dream. So maybe this is a better quote than Einstein. Mr. Faber, I come back to you because you have lived through the many attempts of trying to legislate a common corporate tax base, maybe with BFIT, and then also on the other proposals, what do you see as the main challenges for creating them into reality?
Yeah, the number one is, of course, the procedural one. So the Parliament has only the right to give an opinion, and whatever we say, the Council can do whatever they want. So there's no trilogue or no negotiations with us on the one hand, and there's a need for unanimous decisions, which normally means that the Council makes packages if there's no general agreement with things that have nothing to do with taxation to organize something. And therefore, I'm not as optimistic, but maybe I'm wrong, and then I would be very happy. But coming back to the digital taxation, I think we see that the VAT does not work. And we have a very famous case in Europe. One of the GAFAMs, one of the A's stands for Amazon. And the VAT problem with Amazon is obvious and shows it does not work. Not to go in all the details, but in one of the special committees we made a deep analysis how this issue is functioning. Because you have to be aware, our tax system works in a way that you have someone who is producing something at a special place, investing, and then producing. So if you take the water here, there's a company Spa, who has somewhere a fabrication, has an investment, produces water, sells it, has revenues out of that, and then you make a calculation, what has it been invested, what has been, what is the profit at the end, and then you tax it. If you don't have a real company, so where's Facebook? Yeah, where's Microsoft? If I go through all the GAFAMs, where's Google or Alpha? Or Meta, sorry, not Facebook, Meta now. Where are they located? And where do they create the revenues? And how can I bring the taxation to the place where the value is created without having a branch, an investment? And that is the question we have to discuss. Maybe you have better solutions, but only to say, oh, it's not fair, and even losses are taxed. Oh, we have that in other taxes as well. If I take the German Gewerbesteuer, do not know how to translate it because it's a very German approach, but even that creates taxation when you have losses. And therefore, we even know there's problems in our tax systems and can deal with them. But honestly, to address it in a way to say there's no chance to do it properly, so we leave this path is not my approach. But on the BEFIT, coming back to that, I think it addresses internally problems which we have, and we have to address them, because I learned the phrase, when you go out internationally, first you have to solve your problems internally. So, and that's why we really pressed Commission since a long time, and there are a few resolutions where we asked to come up with this proposal. And from Parliament side, we will do whatever we can with our national colleagues, what has been mentioned in the speech before. That is something we can organize a public debate on that, together with you, for example, the Tax Observatory. We can organize meetings with our national colleagues to make pressure on the national governments to move, and of course we can make some pressure on the European level as well, to council members with the Commission together as our ally on this area against the Council, because the problem is not the Parliament, the problem is not the Commission.
Opposite.
Here. Up on the hill, yeah.
I'm going to give each of you the chance to respond to this question. I'm just going to ask you to keep it brief because I want to give the chance to our welcome guests to pose your questions. So, Georgia, I see that there is a
very quickly.
a bit of
Maybe we can meet Mr. Faber and go through the various options. My point was that we could have thought more carefully about changing the VAT and what needed to be changing in VAT, because the VAT does exactly what the DSTs do, raising revenues in the market. I know it's not perfect, it's far from perfect, but also introducing a tax that we know is very distortive. It's not what we want for our economies. I think we should have taxes that are less distortive. We raise the revenues that we need to raise, and then we redistribute, we produce the public goods that the Europeans are so good at producing. But DSTs have been eliminated from our systems long ago because of a reason. And why today having them back?
Chiara, if you want to give me your view on, what do you see as the mountain to climb to get an international agreement or a EU level
I
one?
think 2 points here. One is the need of revenues. The need to raise the EU own resources, first of all, to repay for the next generation of EU, and the member states have interest in repaying for that, but also for the EU external action, for the big humanitarian crisis that we have, for the gaps in the climate finance and the loss and damage. And then there is an issue of increasing inequality. I think that EU politicians, member states, they have to listen and to see at the citizens. And citizens cannot accept anymore the level of inequality that we have today. The 1%, the rich 1% captured the 2/3 of the gain from 2020. And this is also due to the increase of corporate profit among food and energy multinational companies. We estimated that they increased profit by 2.5 in 2022 compared with the years before. And I think this is not acceptable anymore. So really, politicians have to give an answer. And just to conclude, at international level, maybe an obstacle is an issue of legitimacy that is connected to what I was saying before about the UN. At the UN level, there would be more consensus, all countries on board to discuss tax reforms.
Thank you. Mona, we come to you.
Yes. So I'll start by saying that first there's the political, issues. Like, for example, for BFID, you're going to have all the EU members to agree, all of them on it. So it's not very easy. For Pillar 1 also as well, it's almost like 150 countries. So here we have the political challenge of countries agreeing or not on it. In the case of Pillar 1, if the US and China don't agree to be part of Pillar 1, countries cannot, because most of the covered MNEs that are in scope are actually either from the US or China. So if these two countries are not on board, countries cannot claim the reallocation of profits from them. So this is also very critical. So this is from the political side. Then on the design of the different proposals, Pillar 1 is complex, so there's going to be a challenge for multinationals to apply it. The positive thing is that unlike the STs, they account for double taxation, so there's not going to be the issue of double taxation. For DST, it's a bit more simpler, and that's why we are seeing many DSTs flourishing in different countries, but it has, of course, the issue of double taxation that was mentioned. But maybe, like with some changes, it could be implemented in a better way, because I don't agree here with Georgia. The VAT and the DST, tax different issues. So DST and Pillar 1 as ideas are needed, maybe not in the design that is now, if it distorts some activities or the taxation, but the ideas are very important and respond different. They are different from the VAT. They do not
Address the same issue.
Yes.
Thank you very much. We'll have 2 or 3 minutes more conversation, then I open to questions. So there will be a roving mic. Prepare them and raise your hand. Monsieur Angel, we come back to you. The idea of Pillar 1 and Pillar 2 came after the EU, as you said, had raised the issue of digital taxation, and then the EU effort was put on the shelf to allow for the international negotiations to go forward. We are coming now to the deadline, and Mr. Thomas reminded us in the middle of 2023, you will have to report back to the Council on the state of affairs on Pillar 1 and Pillar 2 in June. So what will you tell them in this report? And eventually, if there is no agreement at an international level, and you hinted that you will assume that the DSTs will resurface, well, you will have some decision-making power onto whether the EU will go there unilaterally, will you?
I think it's highly premature. At this stage, the priority is to finalize the work on Pillar 1. It's on track for finalizing the discussion in the inclusive framework meeting that will take place in Paris at the beginning of July. then it will be open for signature, and after the signature comes ratification. It's a bit a school of patience because it's a treaty, and as such, ratification is a very long process. The BEPS convention, for instance, is still not ratified by some of our member states, and it was concluded in 2017. But what matters is that we put it in the right direction, and that's the reason why the Commission intends also to table a directive transposing Pillar 1. It is not strictly necessary from a legal point of view. That is the main difference with Pillar 2, where most lawyers agree that without a directive there were element of weaknesses as regards the compatibility with union law. We have no such problem with Pillar 1. But from a political point of view, the idea is to try to do the same thing that we have done successfully with the directive on Pillar 2. Before we adopted our directive, Pillar 2 was dying. And if we had failed, we would not be talking about Pillar 2 today. There would be no Pillar 2. The very fact that we adopted our directive has kick-started a worldwide process of adoption of Pillar 2. So if the European Union adopts quickly next year a directive on Pillar 1, the message it passes to the rest of the world is a very strong one, and our capacity to trigger a positive spillover effect is very strong. Will it be sufficient? I hope so. Time will tell. We know some jurisdiction, particularly one on the other side of the Atlantic, where the debate is very heated and where there is a lot of division for the time being. But we should not doubt our willingness to get it done. We promised it also to some of our member states that we would do our best to get Pillar 1. We genuinely care for it. And we think that by having this directive adopted, we will not get the critical mass that is needed internationally for the convention to kickstart. But automatically, we will already deliver a significant portion of the buy-in that is needed for Pillar 1 to start on a good and sustainable way. And that's the political plan.
Thank you very much. I would like to take a few questions. Maybe there and there we'll take 3, and then the next round. Please be brief and also introduce yourselves. Thanks.
Hi, Elodie Lamer with Tax Notes. I have 2 questions for Benjamin Angel that I won't get to ask later. First, can you tell us what happened with SAFE, which was dropped from the temporary agenda of the Commission? And then we know that SAFE is one of the proposals that are expected that are in the pipelines. I was wondering if there was something else that hasn't been announced yet, but is in the pipeline, such as something on domestic bank secrecy or a QMV proposal, maybe. Thank you.
And maybe the lady over there had a question. We can collect 2 or 3 and then go.
Regarding what Georgia was saying about DSTs, I will ask, Mona Barako has already mentioned VAT and DSTs would serve different purposes. Corporations, for VAT, they act just as intermediaries. And DSTs, one thing that they would have is that, of course, they would tax companies that report 0 or negative profit, because they might be using profit shifting to not pay corporate taxes. So DSTs would substitute corporate taxation when these big digital companies are not taxed. And in fact, recently a report from the UK has shown that very big digital companies in the UK that pay almost no corporate taxes, they are paying more DSTs than corporate taxes. So don't you see this could be at least a temporary solution to at least be when Pillar 1 is not still a little bit stuck, the negotiations on Pillar 1.
And then the gentleman over there had a question too, and then we'll go first to Angel, then to Georgia. Over here, please.
Thank you. Hello, I'm Kane Borders from the EU Tax Observatory. I just have a question on Pillar 1. Since it's a multilateral solution, I think this would be preferable, and I think everyone would like a multilateral solution. And just one of the big problems we see is really developing countries. Tututoro mentioned their study that's showing developing countries aren't going to gain a lot from Pillar 1, and the EU Tax Observatory also has a study in this sense. And in the UN, we've seen developing countries looking to create their own process for international tax reform. And Mr. Angel has mentioned that possibly in the long term, the Pillar 1 revenue threshold might be lowered from 20 billion to 10 billion. I found this interesting. And I'm wondering, is there other ways that people are thinking of making Pillar 1 more acceptable to developing countries? Thank you.
Thank you. We'll start with a question about SAFE and the agenda. Monsieur Angel.
Well, that's an easy answer, actually. You should not over-interpret the Commission agenda, which has a lot of back and forth for virtually all tax. It changes all the time. So the variability that you have seen on the various tax texts is just to be attributed to the fact that there are many priorities in many different fields, and that there is a centralized management of the points that have to go to the college, and a wish to give priority certain days on certain topics and some other day on some other topics. But we are still working on all the tax priorities that we have announced.
So will SAFE come this year?
Be patient.
Giorgio, do you want to answer the question?
The other question on the DST, thank you for the question. I think I'll start from the profitability versus paying DSTs. It's normal that some companies pay less corporate income tax than DST, because if your profit is low, or if you're making a loss, you don't pay corporate income tax, or you pay very little. Whilst with DST, you always pay that, because we don't deduct the costs, as we said. So that's not surprising. On DST versus VATs, I think there are ways of making DST, VAT working for the digital economy in the same way. And the winning point of VAT is that it doesn't need physical presence. You need someone to sell in your market. Okay, that's where VAT is very strong on the digital economy. Okay, having said that, I think it's a matter of how ambitious do we want to be for our economies. If we are really ambitious, we think about solutions that are not distortive. Okay, and that's how our founding fathers were, for example. That's when they brought in VAT and eliminated other types of taxes. But maybe we need to have a broader conversation, because I think that coming from academia, this type of view is common, that you should use VAT when you want to tax in the market. It's very clear why VAT is very strong on that, although not perfect. But maybe we need a public debate on that, and I accept that.
Thank you. And then, I don't know if you had anybody specific in mind for your question, or anyone?
Mr. Angel was the one who mentioned the possible lowering of the revenue threshold for Pillar 1, so this would be maybe the most pertinent.
Maybe for you then.
Yeah, this is already enshrined in the agreement, this direction of lowering the threshold after a couple of years of implementation. Now, as regards the general issue of whether the less developed countries are well treated or not well treated in Pillar 1, I would take, you won't be surprised, a rather nuanced view. The nexus which has been retained in Pillar 1 is extremely low. Actually, in most countries of the world, it's only 250,000 euro. It's hard to imagine a lower nexus. And this was done for only one reason, which is making sure that as many countries as possible get something from Pillar 1. Now, the overall amount which are at stake are not gigantic, because as such, it was recalled, it only captures 25% of the taxable base over a 10% profitability threshold. So when you distribute this among a large number of countries, it's almost unavoidable that countries with a larger GDP get a larger share than countries with a smaller GDP. But to be honest, from an economic point of view, the opposite would be weird. This is, by construction, some things that just reflect the economic reality as is. But the effort which has been done with this low nexus is already a very substantial one. And you have to keep in mind that, seen from a business's point of view, it brings complexity, this law nexus, because it means you have much more countries which are concerned that you would have with a Norman one, which is usually significantly higher than this 250,000 euro. So saying that no attention has been paid to it would be unfair. You may consider that they don't get much income, but this is only due to the fact that the total income that is redistributed in this first stage is not gigantic.
I saw that both Chiara and Giorgio had a point. Maybe Chiara first and Giorgio.
Yeah, just to say, so if we look at what ATAF, the African Tax Administration Forum, proposed on the BEPS, they were asking for a higher reallocation percentage of the residual profit so that the revenue could be higher and can be worth it, but also to consider other kind of factors, so not only sales, but also employees, and also have more companies in scope. And we have also to consider that Pillar 1 comes together with Pillar 2, where it's true that all countries gain a bit, but the benefit of rich countries are higher because the right to tax first is up to residence countries that are main part rich countries. And so we have to look also at this unfairness in the two pillars together.
Thank you. Giorgio.
I think, Paola, that I wanted to add that we have been running some calculations on Pillar 1 on real data of companies. And what comes out is exactly what Mr. Angeli is saying. Many developing economies, middle-income economies get little. And the driving factor is because their economy is small. Their market is small. With respect to our markets, they are large and very wealthy. Very big. So clearly the value of our markets is much bigger than anything that we can find in other parts of the world. That's the driving force. Absolutely. That's the first, the explanation why some countries don't get as much as they expected. We could have increased amount A, but that would have meant taking revenues from us to other markets. So a big trade-off, I think. And it's not by chance that the agreement landed where it landed.
I will give you the floor in a minute. Does anybody have more questions, and can they get maybe the mic? Maybe 1, 2, and 3 if we have time. And there's a lady over there. Let's see if we can run a little bit of time. But Mona, please, while we get the mic to them.
Okay, just to add, because the question of thresholds was mentioned. So for the profitability threshold, which is 10%, it's quite high because, for example, Amazon doesn't have a 10% profitability. So, for example, in Pillar 1, Amazon is not there. And this is critical because when you apply Pillar 1, it means that you need to remove all your DSTs, the digital taxes, and it means that many digital companies are actually escaping being in scope in Pillar 1.
Thank you. So, lady with the mic.
Okay, a quick question. I'm Sune Bertelsen, Chair of Tax Policy Group of Business Europe. The subject for today's conference is very important, building EU's own resources. My question is, can we have more EU-owned resources without higher taxes on business? And perhaps a teasing question, what could we do to get more, for example, digital business in Europe? We don't have very many. They are in the US and China. Can we do more to get business in Europe and get more wealth and taxes?
Okay. Thank you. Lady?
Yes. Oh my God, I've never seen this before. All right. Thank you so much. Tove writing from Eurodat, and thank you for a very interesting debate. Just a question on Pillar 2, because this is very much for Benjamin and Gail, of course. Pillar 2, there was a lot of high-tax European countries that were actually expecting substantial revenue gains from the minimum effective corporate tax rate. But the qualified domestic top-up tax changed the picture. And there is a risk now that the low-tax jurisdictions that some of us call tax havens will actually be the ones grabbing the revenue within the EU, but we're also seeing countries like Switzerland really position themselves to use the qualified domestic top-up tax to keep the revenue in Switzerland and even link that to new subsidy schemes that are aimed at, in one way or the other, channeling the extra tax income back to corporations to protect Switzerland's position as an attractive jurisdiction. Does this worry you? Because I think it worries us very much that the tax havens are still gaining. And linked to that, you seem to be saying that developing countries get very little from Pillar 1 because we all get very little. So now there's a new UN track opening up, and the Africa Group wants a UN convention on tax. Is there something to be gained from a European perspective in engaging in further global negotiations together with the Africa Group and everybody else?
Thank you very much. We'll answer this first, and then the mic goes to Todd, and then to the lady over there. Benjamin with the last, and then to the gentleman.
Yes. What Tove presents as negative, I would present as positive, actually. I think that the insertion of the qualified domestic minimum top-up in tax in Pillar 2 is a very important and a positive development, which is fully in line with the philosophy of the pillar. Pillar 2 has never been about plundering your neighbor. It has never been about, oh, this neighbor is not taxing enough, let's take the money. Pillar 2 is about creating condition for a fair tax competition by ensuring minimum taxation everywhere. So in that sense, I take it as a positive development that some countries which today do not have corporate income tax are introducing a corporate income tax, at least for the companies which are in scope. United Arab Emirates have announced that they are introducing corporate income tax. The Crown dependencies, Jersey, Guernsey, etc., are introducing a corporate income tax, and all this is due to Pillar 2. So Pillar 2 creates a floor for tax competition, and from a development angle, I think it is a major development that is very much understated, and sometimes understated by NGOs, I must say. If you're Germany, if you're France, if you're United Kingdom, if you're Italy, you can afford having pretty significant taxes and yet be attractive for businesses, because business invests for a variety of reasons. Taxation is just one of them. If you're a small developing countries with very little to offer, and your neighbor is moving to 0% corporate income tax, you're under a hell of pressure to go for a 0% tax. If a large M&E is telling you, I'm ready to invest, but I want a sweet tax deal, your capacity to say no is zero. With Pillar 2, we ensure that all countries can get at least the minimum level of resource that they need from the corporate income tax, and that is a major development. Now, the UN process has been mentioned a number of times. I think it's good that discussions develop in the UN. Obviously, we have to avoid that this process would overlap or somehow challenge what already has been constructed via the inclusive framework with 140 countries. But there are plenty of areas where we can develop international cooperation even more. VAT, for instance, personal income tax. We all love corporate income tax, and maybe as a person in charge of corporate income tax, this is not the one thing I should say, but it's a small part of the resource of the country. In the European Union, we're talking of 6 to 7%. In the developing countries, it's a bit more. It's around 19, 20% max, but there's a big room to focus also on the 80% that is left to try to come up with international cooperation, which helps those countries to get the resources they need to grow.
Thank you. I am told that we have to close it, but I'm going to give you the chance to answer to the Business Euro question, and then there will be a coffee break, so if you have a more burning question for our panel, grab them on the way out.
Yeah, thank you very much. Try to be very short, but the question was on the own resources. You know, the Parliament has adopted last plenary its report. I'm not very happy about that, because it's a little bit of everything from everywhere, which is not addressing the problem. But that brings me back to our discussion, because the founding fathers, especially the German one, Otto von Bismarck, would be happy to have known what digital world is creating, and he would have taxed it.
But with VAT, with VAT.
No, he didn't knew the digital world, so he invented only the VAT. Why did he invent it, or the federal government? Because at this time, the Deutsche Reich was financed by contributions of the Länder, of the regions, and only indirect taxes have been foreseen for the federal government. That's why they invented a lot of indirect taxes. The Schaumweinsteuer, the taxation of champagne, the taxation of electric bulbs, for example. All of these things we got rid in the last years. But that's why they've been so innovative. And I think we have to think on something like that. That's why I'm a fan of a digital services tax as our own resource, because that is creating a fair competition inside the single market on the one hand, and creates enough money to finance all the obligations which have been mentioned already and will come up. On the other hand, I'm in favor to transfer one indirect tax, 100% from member states to the European Union. That would be more helpful than to get a little bit from everywhere. And therefore, I hope that we get a new momentum on this discussion, because member states cannot deliver all obligations to European Union without the funds. And we cannot address everything without money. And if you look, the financial frame is already squeezed like a citron, it's empty. So any new thing coming up, we can redistribute the third, the fourth, the fifth time the RRF, of course, we can do that, what we did already with Repower EU, but at one stage it will be empty as well. And the same goes for all the other resources we are squeezing out at the moment. So therefore, we have to have a serious discussion on new own resources, and that was the promise Council gave when agreeing on the Recovery and Resilience Facility. So therefore, the obligation is on the Council side, and we make the pressure to get something.
Thank you very much. Please give a round of applause to our panelists.